for having me back. Great to see everybody. Before we get started, can I see a show of hands who in the audience works with commercial properties in some way? All right, not bad. For the rest of you that did not raise your hands, you are stuck with me for a while. Sorry, try to make it as interesting as possible. Okay, we have a lot of content today, and we're going to start with a high-level look at economic factors based on CBRE's house position. We're then going to move into capital markets, and that's your financing, your returns, where properties are trading, and so forth. We're then going to cover some high-level points on the main food groups of commercial real estate. And you'll note we have, of course, office, retail, multifamily, industrial, and new this year, data centers, which has become a really, really hot asset type. And finally, we're going to cover what I think is everyone's favorite part of the presentation, and that's the future of commercial real estate, where we go through sort of some big picture things that maybe you haven't thought about that are going to become relevant in the next few years. All right. Starting with economic conditions, we're going to take just a quick look back at 24 to kind of set the stage. We have the S&P rising by 22.5%. Not going to give any stock commentary, but that is a huge run-up. So where that goes from now is something, of course, that we're watching because it affects the availability of funds. House prices rose 6.8%. I am not touching that. We're going to let Lawrence comment on if that's a lot or a little. But again, another data point that kind of is a framework for commercial lending as well. Disposable income rose by 3.1%. Now, disposable income does take into account inflation. So this is an important measure because it determines consumers' overall spending power, which drives, of course, a lot of our commercial real estate needs. Total household debt did increase as well, although not shocking, but it's definitely on the way up. So it went up $147 billion, and the more important piece of that, I think, is the debt delinquency numbers. So debt delinquency rose from 3.2 to 3.5% in Q3, according to the New York Federal Reserve. So we are seeing an increase in borrowing, but we're also starting to see the increase in debt delinquencies. Again, not shocking numbers, but something that we're watching as an overall trend. And then finally, we are all really, really tired, I know, of talking about inflation, but it's still here, it's still relevant. Headline inflation came in at 2.9% at the end of 2024, so we are not quite at the Fed's 2% target, but clearly on our way there, and light years better than where we were in terms of inflation this time last year. Okay, let's move on. So this is, again, CBRE's corporate house position. It changes, so I'll give you a link so you can follow all of our forecasts throughout the year because the economists globally are constantly looking at this and updating the numbers, but these are our latest forecasts as of this week. So we think annual GDP growth will go to 2 to 2.5% in 2025. We're at about 3.1% for 24, so a slowdown of the economy, but that is still considered a stable level. Unemployment will fall right around where we are. I think we're about 4.1 right now, so maybe a slight or modest uptick in unemployment. Again, nothing shocking here. Inflation, we are really hoping, is down to 2 to 2.4, but as you'll see, we'll cover in just a moment, there are a lot of competing factors that could influence that as well. And then our federal funds rate, we think will come down modestly. These are the interest rate cuts that everybody is always talking about, to 3.5 to 3.75%. So that translates to roughly 50 to 75 basis points of cuts throughout 2025. So not a huge move. 10-year Treasury should be down modestly from where we are today, 4.2 to 4.4. What does this mean in summary? Higher for longer. Again, we all want lower interest rates, but it looks like we're going to settle a little bit higher than we thought we would this time last year. Strong corporate earnings are expected to continue, which should bolster job growth and keep that part of the market strong. We wrote falling interest rates. I think that might be extreme. Modestly declining is probably a better way to put it. We are watching potential inflation impacts from tariffs. You've heard a lot about this in the news, how strong the tariffs are, how they're put into practice and so forth will affect whether it does impact inflation or not. But that policy is something that we're watching. And then good news, the US banking sector is considered to be resilient. So we are no longer worried about a widespread banking collapse like we saw in the great financial crisis. So that's off the table, and I think the banking sector is stable. Okay, the election impact, love 'em or hate 'em, Trump is here. We have our new administration and change is already happening, as our other speakers have noted. Potential positives for commercial real estate. We have tax cuts and deregulation, which both could spur economic growth and is traditionally good for business. Potential downsides, like we mentioned, tariffs and tighter immigration control, which could constrain the labor supply, and a constrained labor supply can lead to inflation. So as you can see, there's factors on both sides of this that we're really trying to watch to figure out where interest rates at the end of the day are going to go. Fiscal policy will also have some impact on the cost of capital. Now, fiscal policy means basically how much the government is spending. Traditionally, the Republican administration is a smaller government, less government spending platform. So if we have less government spending, that means there is more available funds for other investments in the market, so more capital available. Expansive fiscal policy typically means higher interest rates. So we're hoping that restrictive fiscal policy helps keep rates down as well. And then finally, to the positive, if we do continue to see higher interest rates, that should bolster multifamily, because unfortunately it will be expensive to buy houses and people will rent for longer. Probably not what those of you in residential want to hear. Okay, capital markets. We're expecting a mild investment recovery due to all these factors this year. So thankfully the market has bottomed. We are seeing an uptick in activity, and we're forecasting roughly 5 to 10% of investment uptick this year. The biggest challenge we have is the bid-ask spread remains very challenging. So we have a lot of owners who bought at prices 30 to 40% higher than where their properties are valued now. So a very significant spread in property values. Buyers are looking for positive leverage, meaning they want a return higher than the cost to borrow. That bid-ask spread is narrowing, but is still a very, very difficult part of the market, and unfortunately there's no easy answer for it. So because of that, we think that transaction volumes will remain muted with just a slight uptick this year. All right, this is a more academic look on how cap rates are influenced. And for those of you who don't look at this every day, a cap rate is your return on commercial property without any financing. It's a really basic metric to look at what your return for the asset will be. Now, a lot of things besides just interest rates affect cap rates. The economy, big picture, right, goes into capital markets conditions. Those are your interest rates and your borrowing rates. Then we have liquidity, which is your availability of funds, like we just talked about, which is dependent on fiscal policy, global policy. You have risk. What is the perceived risk of commercial real estate in the world? Do we think that the assets are stable? Are they not? Those impact cap rates, just the perception of risk for specific asset types. Fourth, we go into global asset demand. Do we have capital coming in from other countries, or is our policy restrictive that we don't have the funds flowing into the US from a global perspective for investment? And finally, we have our economic expectations. Often clients will be willing to take a lower return if they think economic conditions are improving. Perhaps they can refi down the road. If they consider that conditions are stable or perhaps even deteriorating, they're going to want a higher return or a higher cap rate to compensate for that risk. So these are all the factors that we're watching. Because of that, we think cap rates will be flat for the first half of 2025, and then we're expecting mild cap rate compression in the second half of the year. This is really applicable to institutional investors. So we work with a lot of pension funds, REITs, a lot of very large companies on the institutional side. And what we found is that historically they have had asset allocations, meaning we have X percentage to Class A multifamily, of X percentage to industrial. Now, because there are so many competing factors, it's really going to an asset-specific selection process. So the pendulum has swung back to individual real estate fundamentals, which probably sounds funny, right? It's always been about location and real estate fundamentals. But for a lot of years, it was more financial engineering on the investment side. Now we're back to specific asset allocations along with balancing the market selection, the asset type, and so forth. So it's just a different evaluation process than we've seen for the rest of the previous cycle. All right, let's go to each individual asset type. Office. You say that with a sigh, right? It's like, okay, here we go. So the office market remains challenged, but there are pockets of opportunity, as Joe mentioned. We think that hybrid work has reached a steady state. So the conversation the last few years was, when are people returning to the office? Are they going to be in 5 days a week? Are they going to work full hours? I think everyone's basically done having that conversation. Maybe not a few CEOs who are still holding out hope, but hybrid work has established sort of the pattern here. So we think that is whatever a company is seeing today is what is going to persist to the future. So the good news for that is you have predictability now to plan out your office usage and portfolios. The challenge is it's still not full-time. So what do we do with all this excess space? Prime spaces are actually going to become scarcer, so vacancy will be decreasing because we've had a marked slowdown in new construction. So we are predicting that vacancy in prime spaces, these are your Class A office buildings with all the amenities, maybe they're near transportation, will come down to basically their pre-pandemic vacancy rate by 2027, so a few more years. Now, on the opposite side of that, we have overall vacancy ticking up to about 19% in 2025. The most challenged part of this is commodity office, and this is really where investors and owners are having to get creative. So commodity office is your suburban office park, not great occupancy levels, not a lot of amenities, often Class B and C style space. We're seeing a lot of debt refinance stress. For those of you in the lending side, this is not a surprise. There's just not the cash flow in these buildings to refinance at current rates. So a lot of stress to lenders, a lot of stress to borrowers when their loans are coming due. Ongoing price discovery because of the sort of structural issues with office, meaning the occupancy levels, the lack of tenancy, and then debt refinancing stress. So we do have continual price discovery. Tenants maintain the leverage for commodity office. We're seeing a lot of landlord concessions. We're seeing a lot of negotiation on rent rates. But even more than that, what is new this year is tenants are really having to pay attention to the landlord's position in the property. What do I mean by that? The landlord's position is, can they pay their debt service? Do they have excess capital to pay for capital improvements? Do they have money to pay TI or tenant improvements to attract new tenants? If there are not reserves, which in a lot of cases there aren't at this point, the building could kind of fall into disrepair. It could be challenged long term. So now instead of just what rent rate can I get and do I like this location, it's what is this building going to look like in 5 years, in 10 years? Is this a place that I can move my business and feel comfortable with the trajectory? And unfortunately, that's not always the easiest information to get. If you're a landlord, you're going to hold on to that pretty tightly, but that's the discovery and the questions that tenants are starting to ask, which makes sense. We also have subpar office-dependent job growth. So the jobs reports have all been very strong, as you've seen, but a lot of those numbers, if you dig into the details, are in hospitality, they're in service, they're in government spending. They're not in office-dependent jobs. So the growth, if it's not coming to office-dependent jobs, you're not going to see the increase in occupancy. So that's been another challenge. Finally, we have increased sublease space available, often at lower rates than the primary leases, so that's pulling down the market as well. And then overall vacancy rising in Class B and C office. So I know that was a really bright, uplifting slide. It's not all doom and gloom, though. There is definitely opportunity in well-located buildings, and then there's some wonderful creative redevelopment happening on the buildings that make sense to transition to multifamily or other uses. So it's just, I guess the message is it's in a state of discovery still, and we've not quite figured out what to do with all of the commodity office. All right, retail, completely different side of the spectrum here. We still have historically low vacancy levels. And if you look at this graph on the bottom, This is the supply pipeline. So these are all the projects coming online, and it is at exceptionally low levels. So we have very high tenant demand. We have tenants who are trying to expand. They cannot find space. We have limited construction because the cost of capital has really constrained new development projects. Very, very few construction starts are happening. Because of that, rents are still increasing and vacancy is very low. The potential store closures could actually be a good thing, especially if the location is well located. I'll give you an example. Last year, the Bed Bath & Beyond bankruptcy. Many of those leases actually went to competitive auction. They never went up just for lease, as we would all list properties for lease. They were auctioned off to the highest bidder, and other companies bid on those leases because they needed the space. The landlords who were able to get their own space back were thrilled because they could then release it at much higher rates. So bankruptcy is not necessarily a bad word if you're a retail landlord. Sometimes it can be a huge positive if your property is well located and welcome to have the space back available. So take those headlines on the bankruptcies with a grain of salt. Retail is not dying by any stretch. Certainly there will be some challenges for properties that don't have strong demographics or strong traffic, but overall we are really looking forward to have some of the prime space back. Markets to watch. So these are sort of the hot up and coming areas for different reasons. Phoenix, we have a lot of growth in the suburbs and a lot of retirees moving there, which is bolstering retail development. Austin, we have the tech sector on fire, so a lot of population migration there, which is, again, boosting retail development. Dallas has become sort of this market to watch as you must be there. If you're a boutique or a national retailer, it's got to be part of your portfolio. Nashville, we all know the booming tourism and music scene, but they also have a very strong growing healthcare sector. So that is increasing retail demand. And then Charlotte is a tech hub and finance, as we know, so a lot of population growth there. When you have population migration and you have job growth, it leads to retail development as well. Okay, this I put in just for all of us because the #1 fastest growing grocery market in the United States is Northern New Jersey, New York, Long Island. Now, I know we're in central New Jersey, but it's close as I could get. So the #1 market for growth is the Northeast. It's the tri-state right here with 105 new grocery stores planned, and we are beating out all of those Sunbelt markets that we're all probably really tired of hearing about. So I thought this was good news. All right, let's move on to industrial and logistics. It's evolving. We have a continued flight to quality in 2025 as occupiers are really looking to facilitate automation, artificial intelligence. They want more employee amenities. So again, that prime space is in demand, but it's very difficult to build, especially in markets like ours with high barriers to entry. We are seeing some of the older space, as Joe mentioned, tick up in vacancy as there's less demand. So we have the market that's starting to bifurcate, and that has not been the case the last few years. It's just been rents growing, rents growing, rents growing. Now things are slowing down, especially in the less prime space. 3PL or third-party logistics are really driving most of the growth, as you might expect, for delivery services. And we are saying that leasing activity is going to stabilize in 2025. So we think supply and demand nationally is going to be stable. The other takeaway here is you do have slightly increasing vacancy across all of these different subsectors. So port, non-port, seaport, vacancy is ticking up modestly across the board. Multifamily. This is an interesting one. We're calling it a cyclical recovery just ahead, and it feels probably strange depending on which market you're talking about because each submarket is so very different in multifamily. But we actually will have more units coming online in multifamily since any point in history since the 1970s. So we have a huge influx of supply coming online last year, this year, and into the beginning of 2026. So because of that, we're expecting the pace of rent growth in the Sunbelt and mountain markets, where most of the supply is coming online, to decrease. Now, I didn't say that rents are going to decrease. The pace of rent increase is going to slow down. So we're still seeing rising rents, but just not at the fervor that we've seen the last few years. The Northeast and Midwest have completely outperformed due to barriers to entry and lack of new construction. So rents have risen, occupancy is high. Those have really been our outperforming markets. And then we're going to see a reversal. So by mid-2025, construction starts are expected to be down 74%. Now, we're not going to feel that for a few years, but if you take out new construction supply 74% down, in 2 years, when those projects would be coming online, it's going to be a very, very supply constrained market. So right now we have excess supply in certain markets that's being absorbed and affecting rents, but in another 2 years, it could be a very different swing of the pendulum. The cost to buy premium is going to continue to favor the rental market. I know Lawrence will touch on this, but basically houses are unaffordable. If you're a multifamily investor, that's a good thing for you because you know you're going to have more renter demand. We're also seeing people rent for longer, so there's less turnover in the leases. That's a good thing for asset stability, not a great thing for rent growth because you're limited to the increases. The average multifamily vacancy rate is expected to be 4.9%, so still extremely low with rent growth at 2.6%. And again, that cost of buying is driving the record levels of absorption. Data centers, like I mentioned, this is a new one. This was always considered sort of a tangential commercial real estate asset type, right? Not one of the main food groups. Well, that is changing fast. If you look at this graph, it shows you how many data centers were under construction in 2020, 458. Today in 2025, 4,750, and this doesn't even come close to meeting demand. 90% of the projects are leased before a shovel ever goes into the ground. So when that project comes online and you're a company and you need more space, you're waiting years to get a project out of the ground and to completion. The extremely tight vacancy rates, very high utilization, and again, that pre-leasing activity is making expansion difficult in an asset type when there is absolutely skyrocketing demand. So Northern Virginia, Silicon Valley, Dallas, Atlanta, Chicago, you can see the markets where there has been a lot of development. Why is that? Well, tax incentives and availability of power. It used to be that you would pick a site, like our traditional development, right? You pick a piece of real estate you like, all the metrics are good, and then you bring power to the site. You work with the municipality and bring the power to the site. That doesn't work with data centers because the need for power, the amount of power they need is so extreme that you actually have to do it the opposite. You go find the power and you bring the site to the power. So locations that have very robust energy grids or alternative power and available land are where data centers are poised to explode. You can see some new developments coming online in PA and kind of our backyard, and then the rest are Louisiana, Wisconsin, and Mississippi. So places where there is land and not as much demand for the available power. Interesting though, there are a lot of new partnerships coming in line to try to address the need for excess power that frankly a lot of municipalities just don't have. So there's new partnerships between energy providers, nuclear technology companies, data center operators, and municipalities. And all of these groups are coming together to say, how do we solve this energy problem more creatively? And if you look at any of the research, the amount of power needed just to do a simple ChatGPT search will blow your mind. Like the resources that these AI computers are using is really something we have not seen in our lifetime, right? And this is only going to continue. So we have two major data center operators that have actually announced plans to utilize power by nuclear facilities we might be familiar with in the Susquehanna and 3 Mile Island nuclear power plants in Pennsylvania. We also have coal plants that are being retrofitted. If all of their fiber optics and topography, if all of that works, they're being used for alternative energy production as well. All right, here we go to some sort of bigger ideas, things that maybe you're not thinking about on your day-to-day radar. The first is physical climate risk. Now, we're obviously all thinking about this because of the LA wildfires, but there's been a lot of other extreme weather events in the last few years. We have hurricanes on the East Coast, we have extreme flooding, very high heat, very cold temperatures. It's obvious that the physical climate risks are increasing. Now we might think, okay, we're pretty insulated here, more or less, right? Save some significant hurricanes. But wherever there is extreme property damage, insurance premiums go up, and that does affect all of us across the board, right? In the specific areas where high states have had, or there's been high risk states, premiums have gone up 31% year over year and 108% in 5 years. So if we consider this trajectory, that is really impacting the valuations of our property because it's taking down the net operating income or the return. So insurance, what used to be sort of just I'm not going to say nominal, but an expense that really didn't move the needle too much one way or the other, is becoming something that clients are underwriting with very significant increases in a much different way than they were before. And how those premiums continue to rise is something that we all kind of have to expect, but also want to stay ahead of, especially if you are an investor yourself, to make sure you have that durability of income over your hold period. The second piece of this is, how do you underwrite the asset value if it's in an area of increased risk? So really there's not a metric right now saying, okay, my property is in LA, I should decrease the value or create a risk premium of 5 or 10%. There's no, maybe insurance companies have this, but on the commercial real estate side, we don't have resources. Like, that's not part of the discussions yet. So I think we're going to see more conversation about historical risk and then future projections for extreme weather events start to filter into the conversation around asset values and potential appreciation over time. Again, there's not a really clear way to do this aside from just looking at insurance, but I think it's going to become a larger conversation. Elimination of parking minimums. So I know we have a lot of people who represent different municipalities in here, so this is a controversial one. Let's say there are 91 cities in the United States that have completely abolished all parking code requirements. Build it how you want, right? For the developers in the room, you're probably like, what? That is amazing. Maybe you already knew. What did they find in doing this? And again, look at the list. These are not tiny little towns where you would say, yeah, but they don't have people, they don't have population density. Of course they can do that. No. Austin, San Jose, San Francisco, these are major cities that have completely abolished parking requirements. Now, of course, they still have parking, but what does this allow? They found that it streamlined the entitlement process, it allowed for greater use of space and more creativity with development. Really have not been a lot of negativity reported after these changes were made. So I think this is a radical idea because we're all so focused on the code, amending the code, it's very complex. And a lot of towns are just saying, you know what? Times have changed, developments change, prototypes are changing. How about we just abolish that and see how it works out? So that's something that I think more towns are going to consider. And we didn't even talk about driverless cars or the fact that people may not even have a car in the future. This is today. With the amount of cars on the road, do we need as much parking as we have historically? And the answer for a lot of areas is no. Creative development. Because there's been such a constraint on new space, because it financially has been very difficult to get development projects to pencil, we've seen some really interesting creative redevelopment ideas, which I always love to see. These are Rite Aids, which many of you who are in this space know Rite Aid has been sort of in and out of bankruptcy, closing locations, struggling for quite some time. So a lot of their locations have closed. Typically, drugstores are a little difficult to re-tenant. It's an odd square footage for retail, just the way they're positioned. So it's been limited to discount stores, hardware stores, and it's a very small subset of tenants that backfill a drugstore, but not for long. So Express Car Wash, this is actually in Pennsylvania, in East McKeesburg and Pleasant Hills, actually created a car wash within the confines of the existing Rite Aid building. What did this mean? the approval process was really fast. They were not changing the footprint. All of the machines are contained within the walls, so there was noise containment as well, and they needed really very little in terms of change to the site at all. It did cost $3 million, but the level of profitability of car washes would blow your mind, so that was well worth it for them, and I think a very creative use of an existing footprint. We're seeing other tenants get really creative as they try to find ways to expand in a supply-constrained market. These are 4 different Taco Bell prototypes that are all in place. And I'm showing this to you because it speaks to the fact that we no longer have one prototype for every tenant. Like historically, we've said, this is what a Burger King looks like, and that's it, right? If you don't have an acre and a half, you don't have a certain number of cars that can fit through the drive-thru, then that Burger King is not going there. Have a nice day. Name your tenant. Taco Bell has been really, really good about modifying their prototype while still keeping their brand consistent. So the one on the top left is called their Defy model. This is in operation. They actually have multiple in Georgia. How it works, the second level is where all of their employees and their kitchens are. And then there's 4 drive-through lanes. One of them is dedicated exclusively to third-party pickup. So the Uber drivers, Uber Eats, all those different apps, that's just for them. And the other lanes are for drive-up. You can order on a kiosk if you didn't order on your app ahead by a QR code. And then the food comes down these tubes, kind of like a bank teller, like in the big tube. You scan your QR code, your order comes down, you pick it up, and you go on your way. So this is not futuristic, this is today. This is now, this is operating. So they're testing this Defy model, really cool, really interesting for high velocity stores. The next one is their Taco Bell Go. This is a really small footprint. It can go down to ½ an acre, which is really, really tight for a fast food restaurant. They don't have a dining area. It's drive-through only with a very small pickup window. So they're going the opposite way, saying, okay, we want to be in this market, but we just don't have the space, or we can't find a site, or construction costs are too high. Let's build an extremely small prototype store. We're going to make it pickup only, and that's how we're going to service the market. Your bottom left, if you're looking at it that way, is a Taco Bell Cantina. So this is their urban model. They can go inline, which we really haven't seen from them. This one's a little different because they have alcohol, they have a slightly different menu, but they're saying, you know what, we want to capture the urban part of the market. We're not going to get a drive-through. Maybe we get some walk-up window traffic, but how do we cater to that market? Taco Bell Cantina is their answer to that. And then the last one is the love it or hate it, our traditional suburban Taco Bell prototype that goes on an acre and a half, has a drive-through, has a dining room, with a updated facade, but the same box that we're used to seeing with all of our fast food. So expect more variety and prototypes from tenants as they try to find spaces that work and keep the costs affordable from a new development perspective. Drone delivery, I touched on this a few years ago. This is happening other parts of the country quite frequently, mostly in the Midwest. This is Walmart's staging area. So they come out, they park the drones here, they stage them, they load them. It's actually being used for delivery in a 10-mile radius. What I think is different that we haven't really talked about in the past on drone delivery is the use of space, not just for should we deliver by drones, but when we deliver by drones, how do we work in the staging? How do we work in the drone parking? How do we work in space to repair the drones, to load them, to land them? There's actually a lot more than just this little landing pad shown here necessary for drone staging. So as retailers adopt this, with all of the regulations that I know are underway, that's going to be a conversation that developers are going to need to have. How do we accommodate the space for drones and not just drop off and pick up, all of the other elements that go along with it? This is Walmart's drone in the air. It can carry up to 12 pounds, and again, it delivers in a 10-mile radius. And they're finding, because they're using these very frequently, like I said, in other markets, that areas that have adopted drone delivery, the footprint of the store can decrease and do the same volume. So we might see some change in prototypes as more square footage gets allocated to the delivery instead of the in-store shopping. Okay, the last thing I'll touch on today is the reality premium. This is the most far-fetched thing that I'm going to cover with you today. As we're seeing more automation, we're seeing more artificial intelligence, which is about to spike exponentially. We're seeing more robotics. We're predicting that there will be a premium on real experiences, which sounds crazy. But an example is a restaurant that is fully automated behind the scenes. Robots will prepare your meal per your exact specifications. We don't think menus are going to shrink. And they'll prepare it, they'll get it out to a certain pickup point, and then real human servers, we still have a place here, are going to come pick them up and deliver them to the table. So instead of always trying to go through automation and how do you make everything faceless, we think the tide will shift over time, and that, who knows, timeline here, to have a premium for reality. So just kind of crazy to think about what could be automated and then what can we make real again and charge more. So we think that's the way things are going. If you want any of these slides, I know some of them might have been hard to see from the back, but if you'd like any other information, this is our CBRE Insights link. Feel free to take a picture of it. There you'll see insights by property type, by markets, by submarkets. It's an amazing amount of data, along with, of course, the economic projections. So any of the slides today, you should be able to find there with very few exceptions. Thank you so much for listening.